and we're excited to have Jake with us now for about 9 years here at the Milner Group. And Jake, by the way, has a degree from the University of Georgia in finance. I don't know if y'all knew that about Jake, but Jake is also married and has 2 children and 1 on the way. So I'm gonna turn this over to Jake, and he's going to tell us all about life insurance for the living.
All right, thanks, Greg. I'd like to thank everyone for taking the time to attend the webinar today. I know that your time is valuable, so my goal is to provide you with information that is helpful to you in growing your business. Living benefit riders have been rapidly gaining popularity over the past couple of years. You're all familiar with terminal illness accelerated death benefit. That's what you would typically think of as just accelerated death benefit on life insurance. Those have been common for a long time. But now it seems that every carrier also has their own chronic illness or long-term care rider, and several have also added critical illness riders as well. There are several distinctions between these riders, and I think they're important for you to understand. I think there are also new sales opportunities for you to take advantage of. So my goal today is to explain the details that you need to understand so that you can generate new sales, you can beat your competition, and hopefully increase your commissions that you earn on each sale. So I want you to have all these details at your fingertips so that you're ready to seize opportunities as they arise. With that in mind, let's get into the webinar. First, we'll talk about terminal illness, like I mentioned, your normal accelerated death benefit rider that you would think of. We won't spend much time on this because I know that most of you are very familiar with it, but I thought there's a few differences between riders that different carriers have that you should at least be aware of what benefits or drawbacks some of them have. So typically, these riders advance a percentage of your death benefit upon a, quote, terminal diagnosis, right? But terminal is up to definition by the carriers. Some of them carriers define it as 6 months life expectancy. Some have 12 months. The more liberal carriers actually have a 24-month life expectancy diagnosis definition, and that is more favorable. The longer the period of time is, the more liberal it is because it's easier for your clients to get that money. The maximum payment you can get also varies from carrier to carrier. This is important to understand. Some carriers only allow you to accelerate up to $250. Some allow you up to $1 million, 4 times as much. It's always stated as a percentage of the death benefit, so usually somewhere from 50 to 75%. So what that rider is going to read like, it's going to say, we will allow your client to accelerate up to $1 million and 50% of the death benefit, whichever is less. Okay, it's going to say something like that. As you're aware, the riders are free. They're automatically included. However, there's a charge when exercised. Your policy premiums are going to remain due. I would say a good example of this is United of Omaha. They are pretty liberal. They give you a 12-month life expectancy definition on their accelerated death benefit for terminal illness. They allow you to take up to 80% of your death benefit, which is very high, up to $1 million. So that's a very strong benefit. On the other side, Lincoln National, you have to have a 6-month life expectancy, so it's harder to qualify. And they only pay out 50% of the death benefit up to $250. Okay, so there's, as you can see, there's a huge difference in what your client's going to get between somebody like United of Omaha and somebody else like Lincoln National. So let's look at a quick example of how this would work. Say your client is diagnosed with a brain tumor, given a 6-month life expectancy. Okay, they've got a lot of medical bills piling up, so they really need some extra cash. So, great, they have this rider. They elect to accelerate 50%. Your client has a $500,000 policy. Okay, so the carrier is going to pay them $250,000, but they're going to, here's where the rider is not free. There's a charge on the back end. If they have an administrative charge, let's say $150, it's usually pretty low, not really a big deal, really just a processing fee. But there's also going to be an interest component to it on the acceleration. Okay, so they're going to have to charge something on their time value of money, their cost of capital. And this is going to depend on how long you live, what the total charge is going to be. So in this case, we're saying the client dies 12 months later, so he dies 12 months after his acceleration, his beneficiaries are going to receive $234,850. Okay, how did we come up with that number? Well, he accelerated $250,000, and then you have to discount the remaining $250,000 of his $500K death benefit by the administrative fee of $150 in this case, and then by the cost of capital, in this case 6% of $250,000. Okay, so the total payout on the $500,000 death benefit was a little over $484,000. So you can see in this particular example, which is a very reasonable example, there was, a little over a $15,000 total cost to the client for accelerating that money 12 months prior to death. Okay, pretty straightforward, and that's pretty much how all of these terminal illness riders work. You just need to be aware that some are much better than others and more liberal. All right, let's look at critical illness. Several carriers have standalone critical illness policies, but some carriers have also started to add critical illness as a rider on their life insurance policies as a way to access part of your death benefit prior to actually dying. So how do these work? These are going to advance a percentage of your death benefit. Again, it's drawing from your death benefit upon a critical illness diagnosis. Okay, this is neat. They will pay you a certain amount of money, the insurance carrier, for diagnosis of certain big events like a heart attack, stroke, cancer. You can see a list there, but there's other. Every carriers are going to have their own list of things that they're going to pay out for. Okay, and it's a pretty big list. Now, these critical illness riders, they're typically free, but there's always a charge when they're exercised. Okay, so the amount that your client is going to receive depends upon the age of their diagnosis, how old were they when they were diagnosed, and how severe is the condition. Now, you could have a heart attack of varying severity that's going to make, you could have a minor heart attack that may have very little effect on you. You could have a major heart attack that could have a severe effect on your life expectancy. So the key here is the carrier needs to be able to project what they think your life expectancy is. It's also going to be dependent on what the max percentage of the death benefit the carrier allows you to accelerate. It's usually pretty high, around 90% or so. Again, there's going to be a time value of money discount rate. This is their cost of capital, let's say 4% in this case, and there's going to be administrative fee. We'll make it $350 this time. I often get the question, what about premiums? What happens to the premiums when you get one of these payments, critical illness payment? Well, the premium is going to remain due, but it's going to remain due on the reduced face amount. So when you receive that accelerated payment for a critical illness, your death benefit is going to go down by that amount plus some fees, and then your premium is going to go down to reflect the fact that your death benefit is now lower. Okay, so that works out well for your client. Let's look at an example of how this would work. Got a male age 45, he's got a heart attack. The doctors think that he has somewhere around a 10-year life expectancy. And he has a $500,000 death benefit. Okay, he's got a lot of medical bills associated with being in the hospital, the surgery that he's had to have. So he would really like to draw on his death benefit. The carrier that he's with allows a max acceleration of 90%. 90% of 500 would be $450,000. The carrier charges a fee of $350, the administrative fee. They discount your accelerated payment by 4% compounded annually over your life expectancy. Remember, we have to calculate life expectancy. The carrier is going to do that. So their maximum payout is actually not $450. Discounted over that 10-year life expectancy at 4% and including the $350 administrative fee, that $450 actually comes out to $303,653. See what happened there? They discounted the amount they're going to pay you. But remember, at the same time, they're going to reduce the death benefit by the full $450. So there's the charge for this thing. Okay, this is a lot more liberal than terminal illness, right? Because in this particular scenario, this guy had a 10-year life expectancy. That's a long time. So the carrier is paying you out a much reduced amount because they're paying it to you so early in relative to your actual death. So they reduce your death benefit by $450. they actually paid you $300,000, and then your premium is reduced to reflect the remaining death benefit of $50,000. Okay, what are some carriers with critical illness riders? Not a ton of our carriers have these yet, not nearly as many as have the chronic illness. But on Universal Life, North American, and Lincoln National have it. Okay, Lincoln National's got it on a couple of products. North American now has it on most of their products. It's a pretty strong rider. On term insurance, American National, Assurity, and then Transamerica's LB, that stands for Living Benefits. All of those term carriers have critical illness. So that's a neat feature you can actually offer to your clients on a term policy. And it doesn't cost that much on term. And with these products, it's automatically included on the term. All right, let's look at chronic illness. There's going to be a lot more details with this because there's so many different types of chronic illness riders coming out, and there's long-term care riders, and we kind of need to understand. I frequently get questions about what are the differences between how they work, and there are some very important differences when it comes to chronic illness riders. So let's look at a definition first. These riders, again, it's advance of your death benefit, in this case for a chronic illness diagnosis, all right? And what is that? That is your trigger for this is either, it's just like long-term care, it's either 2 out of 6 activities of daily living you can't perform, or you have a severe cognitive impairment. All right? These chronic illness riders are, they've been designed under 101G of the code, and because of that, they're an acceleration of death benefit. It's not qualified long-term care. It's considered simply an acceleration of your death benefit, and there's some parameters carriers have to work with because of the way they've done that. One of the parameters is it's always an indemnity style payout, subject to the per diem limit, okay, the HIPAA per diem limit. So indemnity style payouts are good for your clients. We'll go over the definition of indemnity versus reimbursement in a little bit, but they're always indemnity when it's a chronic illness. You don't have to worry about that. They're never going to require receipts of you, and they're not going to pay out more than the HIPAA per diem, which is currently $330 a day. That should be $330 a day. That's incorrect on there. It's $9,900 a month. Okay. All right. There's typically a 90-day elimination, just like a lot of long-term care policies have. Here's a big point. It requires a diagnosis of a permanent condition. This is one of the differentiators between chronic illness riders and true long-term care riders. Is that you could have all kinds of conditions, right, that disable you for a period of time. Say you're in a bad car accident, but it's unlikely that they're going to disable you forever. In that case, a chronic illness rider would not pay because what the insurance company is going to say is, well, this is not a permanent condition. Your physician doesn't think this is going to last forever, okay, so we're not going to pay out on it. But a long-term care rider would pay out as long as you meet the 90-day elimination. So that's a big difference between the two types. All right, and because of that, you had to requalify every 12 months. Not a big deal. You just have to send in a letter, yes, you're still unable to do these things. Okay. When we talk about chronic illness riders, there are two big types. There's the, quote, free ones that come automatically on a lot of different contracts. A lot of carriers have those. And then there's what I call the extra charge ones. Let's look at the difference between these two types. Let's look at the free ones first. These usually let you accelerate up to 24% of your death benefit per year, subject to the per diem limits of $9,900 a month, currently indexed for inflation. And the rider payouts are discounted very similar to how we discounted the critical illness payments that we just talked about. Normally, less than 100% of your death benefit is available for acceleration. So they might let you accelerate, 75 to 90%, but not all 100% of it. The premiums continue while on claim. This is a big point, but they're typically reduced proportionately to your death benefit reductions, just like with the free critical illness riders. Okay, so how would this work for your client? They're unable to perform 2 activities of daily living. The physician certifies their condition as permanent. They don't think they're going to get better. The client elects to take the full 24% of their $250,000 death benefit per year, so they can take up to $60,000. The carrier, though, calculates that this person has a life expectancy of 5 years based on their condition and their age. And so then they charge 5% for their time value of money. That figure is actually going to be listed on an illustration usually somewhere, and if not, the carrier publishes it. So that's not just a nebulous number. You can have an idea of what that percentage is going to be. Okay, so instead of $60,000, the policy actually pays out $46,861 to your client, right? The $60,000 that is discounted over that 5 years, and then they subtract their administrative fee. But your death benefit is reduced by the full $60K from $250 to $190, and then your premium and your cash value are reduced proportionately. Okay, so if that was a 24% reduction in your death benefit, then you're going to have a 24% reduction in your cash value and a 24% roughly reduction in your premium. So you can see this rider was quote free, but it did cost the client, what is that, $14,000, almost $14,000, a little over $13,000 to do that acceleration. So there was a cost for getting that money early. Let's look at the extra charge riders. These are the ones that I prefer. They're so much easier to explain to your client because with the free riders, you have to talk about life expectancy and all this, and at the end you can say, really honestly, I don't know exactly what you would qualify for, what you would get paid, because there's too many variables. With the extra charge riders, you can tell them you can get up to 2% of your death benefit per month, and these benefits are going to reduce your death benefit dollar for dollar. Okay, there's no extra fee. You paid for it with your regular premium. You get 2% of your death benefit per month, and your death benefit goes down by the exact amount you took out. Okay, very strong and very simple to explain to your client. Again, your cash values are reduced proportionately. 100% of your death benefit is available for acceleration. That's a key point. So if you have a $250,000 death benefit, you got $250 you can use for long-term care. If you don't use it all, the rest of it goes to your beneficiaries. It's dollar for dollar. I usually explain it as you're buying that bucket of money. You're buying a certain lump sum of money, and how you use it depends on what you need. You can use all of it for long-term care. You could use a portion and give the rest to your family. You could have no long-term care need. You have a sudden death, and the whole death benefit goes to your beneficiaries. Another big positive for this extra charge rider is that your premiums cease while you're on claim. All of the good carriers have this. Most of them guarantee that your policy will not lapse while you're on claim. So basically your premiums are suspended and you don't have to pay anything. Now, I shouldn't have said your premiums are suspended. The carrier actually guarantees your policy won't lapse, but if you ever came off claim, that could negatively affect a no-lapse guarantee policy, okay? Because they continue to take charges out of your contract, but they just said it's not going to lapse. But what they're doing is you do get penalized if you come off of a claim, but at the same time, you were diagnosed with a permanent condition, right? So that's not likely to happen. Let's look at an example of how this would work. Again, the client is unable to perform 280Ls. Physician certifies the condition as permanent. Client has a $250,000 death benefit. Is eligible to receive up to 2% a month. They go on claim. Their premium payments are suspended. The client can receive $5,000 a month. They end up receiving it for 30 months, and then the client passes away. Okay, probably a fairly typical scenario. Beneficiaries will receive $100,000. Okay, the client had a $250,000 death benefit. They accelerated $150 of it for their long-term care needs. Beneficiaries receive the remaining $100. This is very strong, very easy to explain to your client. What are some carriers with these? The extra charge type, Protective has one. Protective is kind of unique in this because they actually allow you to pick the amount you want per month. So instead of it just being a strict 2% of your death benefit per month, they let you dial in anywhere, I think, from $1,000 to $9,900 a month. Lincoln National has this as well, American General, Prudential. A lot of carriers have the free type, North American, Principal, United of Omaha, etc. Even a couple of them on term there. You can see, again, Transamerica's LB term. They don't just have critical illness, they also have chronic illness on their term. American National has it as well. So there's a lot of carriers that have chronic illness now. There's a lot of differences, and we keep track of those for you. So if you've got questions on them, please give us a call about that, and I'll be happy to recommend the best product for your client. Okay, long-term care riders. What makes long-term care riders, the true long-term care riders, different from a chronic illness rider? It seems that they're almost the same. Okay, there's a few differences. Same trigger, okay, still acceleration of death benefit, but these are usually, they're filed under 7702B, which is qualified long-term care, okay? So the carrier, there's a couple of points there. The carrier is allowed legally to describe them as a long-term care rider in the policy. All right, you'll notice that no chronic illness rider company calls it long-term care. They can't, okay? But the carriers that call it long-term care, it's this type. One of the big differentiators, probably the biggest one, is it does not require the diagnosis of a permanent condition. You just have to meet the 90-day elimination. Okay, so this could be a temporary condition that might last a year or something, and you can still get benefits from it. Okay, a plan of care is required, just like you'd have for long-term care. Most policies, there's a couple of exceptions, but most policies guarantee that you will not lapse your policy while on claim, even though you're not making premium payments. Okay, and I said that we would explain the difference between indemnity and reimbursement, because this is a big point. This is a payout style, and I get a lot of questions on this one. And long-term care, whereas chronic illness is always indemnity, long-term care riders can be either indemnity or reimbursement. So let's take a quick look at how that works. First of all, indemnity. Okay, so these benefits are paid up to a maximum of the HIPAA per diem limit. The company is not going to pay out more than the HIPAA per diem limit. For most people, this is not going to be a problem. I mean, it's currently almost $10,000 a month. For most people, that's going to be plenty, unless you're really living the high life in the long-term care facility. At least around here, that's plenty. Benefits are payable regardless of the total long-term care amount received, the long-term care services. This is a big point. So they're not going to require you to submit receipts. They're just going to want to know that, yes, you received qualified long-term care services, okay, in some amount. And then they're going to pay you up to the maximum that they would. So say you had a 2% rider and a $250,000 death benefit, they're going to pay you, if you want, they'll pay you the full $5,000 a month, even though your charges that you incurred might have only been $3,000. They don't care. They're going to pay you the $5,000. You can use the $3,000 to pay for your care, and the remaining $2,000 for whatever, go on a vacation or whatever you want to do, send your kids on a vacation, whatever it is. So let's give an example of this. The HIPAA per diem limit is $9,900 a month. The insured receives $6,000 of qualified long-term care. Okay, that was its actual cost. But they can still get the entire $9,900 and use the excess $3,900 for any purpose. Okay, most people like this indemnity style of rider. It's easier for the client, and they have the, they can get more money than they actually need to use for other purposes. Reimbursement. These actually require receipts for the service you receive. Okay, the benefits that are paid out to you will not exceed the actual cost of care, and the amount you can receive is subject to the total amount of care received, the total cost, rather than the per diem limit. So the per diem limit kind of has gone away here, and rather it's subject to how much the cost of your care actually was. So here's an example. The insured receives $12,000 of qualified care in a month, submits a receipt, and receives a reimbursement for the entire amount, even though it exceeds the per diem limit of $9,900. Now, some carriers are still going to limit it to the per diem, but there are carriers that do not limit it. They're going to say, you know what, we just want to know what the qualified amount was, and we're going to pay you that entire amount. So this can be useful for some people, but I think overall, because this is more burdensome, it requires receipts, and it won't pay out more than what you actually incurred, I think that most people will prefer the indemnity style. What are the costs of these riders? It's pretty stable across the board, usually 10 to 15% for men, Okay, it's usually about 5% more expensive for females, right? Because they're usually going to live longer in a long-term care sort of situation, and they live longer than men. They're more likely to be in this situation. It costs more money. So how does it compare? I get this question. How does it compare to traditional standalone LTC? Well, the life with the long-term care rider is much more expensive than standalone for men. Usually, about 120% as much. It's a lot more expensive, but it can be pretty close for women sometimes. Sometimes it's only about 30% or more expensive than a standalone long-term care. So very compelling sometimes, especially for women. What carriers have the true long-term care riders? The Indemnity style, Nationwide, Minnesota Life, and Transamerica. They all have true LTC riders, Indemnity style, and then reimbursement, Genworth and John Hancock. Okay. Stepping away for a second from long-term care, chronic illness, all that, there's another new benefit from American General that I wanted to spend a little bit of time talking about because it's unique and it's really a great rider for your clients. They call it the Accelerated Access Solution and the Lifetime Income Benefit Rider. The Lifetime Income Benefit Rider is a type of accelerated death benefit, but it's not for any sort of illness. It's simply to supplement your retirement income. Pretty neat. You can draw against your death benefit for your retirement. So here's how it works. Basically, it's insuring against outliving your retirement funds. It's a guaranteed payment stream up to 10% of your death benefit for 10 years. So it pays out the full 100% as long as you don't start taking payments till 85, okay? It's meant to supplement your retirement. Maybe you've spent down your money by 85 and you need more because you're living longer than you expected. Well, that's what this is meant for. So you have to pay up the policy by 85 to get this, and then you can receive 10% of your death benefit per year for the next 10 years with really no cost to it. You get the whole 100%, and it reduces your death benefit dollar for dollar, cash value reduced proportionately. You can take an income stream prior to 85 as well, if that's useful to your client. However, it's kind of like taking an early Social Security payment. It's going to reduce the percentage that you get. The amount of the payment you get is going to be reduced. It's no longer going to be 100% of your death benefit. It's going to be a reduced amount. Chronic illness coverage is also included with this. So this is a very complete and robust rider. Provides a lot of benefits for your clients. And I've heard people talk about it as you could sell this product and then tell your clients, okay, you've got this insurance coverage to cover you should you live past 85. So with the rest of your retirement assets, we can now plan for you to spend them down by age 85, and then you can use this if you live beyond that time period. Pretty neat rider. And what does it cost? For men, and this is kind of more expensive rider. For men, 20 to 25%. So you have your guaranteed UL or whatever. It's going to add 20 to 25% to the cost of that product. For women, 20 to 35%. So more expensive for women, again, because they're more likely to live longer and use this rider. Kind of counterintuitive until you think about it. It costs less for higher rating classes. Okay, so the higher rated up your client gets, the less expensive this rider is going to be. Because if you think about it, they're less likely to live to 85 and use this rider to its full potential. All right, very neat rider, unique with American General. So why do I think that you should sell living benefits? Why would I sell living benefits? First of all, you're basically giving yourself a 15 to 20% raise right off the bat whenever you sell this because it's fully commissionable. So if it costs the client 15 to 20%, you're going to get paid 15 to 20% more. You're overcoming the common long-term care argument that your client's going to have. Well, what if I don't use this? I feel like I've just wasted a lot of money. Well, not with this type of rider, because if you don't use it, your beneficiaries get a death benefit. Differentiate yourself from your competition. you can offer this rider. Some other agent may have talked to your client about one of these riders, but you may have more insight about how these riders work and which ones are better for the client. So that kind of gives you a toe in on this. And at the same time, you're providing a very valuable benefit to your clients. I think you can also use this to generate new sales opportunities, both with your existing clients and with new clients. With existing clients, what I would suggest is thinking about clients that you've sold policies to probably fairly recently, and thinking about, well, I didn't really give them this chronic illness rider. I didn't really talk about it. They may be interested in it. Why don't I call this list of clients and say, hey, we've got these great new riders that we can add to your policies. Would you be interested if I could give you a policy where you could draw benefits if you had a long-term care need? And that may be an opportunity to get a new sale with an existing client and only increase their cost a little bit, but give them a huge benefit. And then, it may create a lot of new sale opportunities for you as well, because there's a huge need for this long-term care, chronic illness, critical illness coverage. Of those turning 65 now, 70% will eventually need some sort of long-term care. That's a huge percentage. So you have a huge opportunity is what that means. So you tell this to your client, your potential client, give them these stats. Well, what they're probably going to ask is, well, what's my chance of really needing this? You're going to say, your chance? What I would tell them is that we often get, especially in insurance, we get way too caught up with statistics, and we forget that statistics apply to a huge, broad range, a large group of people. What is your client's actual chance? I would say it's either 0% or 100%. That's what I'm going to tell them. Okay, what does that mean? Well, you're either going to need it or you're not going to need it, but that's the whole purpose of insurance. But the nice thing about these riders is most clients are probably going to think, even though statistics don't bear this out, they're going to think, I'm probably more towards the 0%. It's not going to happen to me. Great. If it doesn't happen to you, that's great, and you're going to pass on that full death benefit to your heirs. It's not use it or lose it at this point. So this rider could cover you against that huge potential that this could happen. If it doesn't happen to you, just give the money to your beneficiaries. It's a win-win. All right. That pretty much wraps up what I wanted to say today. I hope that this gave you a lot of information that will be helpful to you in your business. We keep track internally of the differences between all of these riders. We also keep track of which contracts are more competitive. So I don't expect you to know all the contracts on the top of your head. I just want you to know that these riders exist and how they work. Please give us a call when you've got a client, and we'll find the best one for you and talk to you about it and why it's the best one. So this time, if there's any questions, there should be a box on your screen somewhere where you can, it's a chat box, you can type in a question, and that question will then be read to me, and I'll do my best to answer it.
So we got the first one here, just asking if we can send the outline of the presentation.
We can send an outline of the presentation. Also, though, we have, if you wanted to share this with somebody, we record all of our webinars, and it will go up on our website probably tomorrow sometime. You can just go to milnergroup.com, and there'll be a webinar posted that you could, show this to somebody. But yes, shoot me an email, jake@milnergroup.com, and I can send you an outline if you just want it in a paper format.
So go ahead and give it here just another minute here in case there's any more questions. All right. Is there any tax consequences to any of these riders?
Yes, there can be with some of them. That's kind of a complicated question beyond the sphere of this webinar. I can give you the answers if you call me personally, but there can be tax consequences based on which type of rider you have, how it's paid out, etc. So the answer is, for some of them, yes, but I will tell you that the chronic illness and the long-term care riders are set up such that it's meant to be a tax-free benefit, okay? So for chronic illness and long-term care and critical illness, It's meant to be tax-free, terminal illness as well, because it's an acceleration of your death benefit, and that's an exclusion that the IRS has made. So that's meant to be tax-free. The accelerated, the living benefit income thing with American General, there's probably going to be some tax implications to that one because that's more of an annuity payment than a death benefit payment. But I'd be more than happy to discuss your particular case.
You mentioned going back to life clients with this rider. Any thoughts on going back to LTC clients with the idea of changing to life products with the riders?
Well, I think that standalone long-term care is great coverage to have. There are some benefits to having it with a life insurance contract. The benefits that come to the top of my head are, one, this is usually on a guaranteed UL type policy, so you can tell your client your premium's never going to change. You can't give them that promise with long-term care. So you can tell them your premium's never going to change, and you get rid of the use it or lose it argument. So those are two huge benefits to having it on a life insurance contract. If you're going to replace the long-term care policy with this, I would recommend going with one of the true long-term care riders that we discussed. But yeah, it may create opportunities. It's going to be probably right now a step up in premium for your client, though. But yeah, that may be a good opportunity.
Does Prudential Term offer any of these features?
Prudential's Term, they have terminal illness on their term policies. Prudential has what I call the extra charge type chronic illness rider on their universal life. It's a robust rider. It pays the 2%. Importantly, it's one of the ones that guarantees that if you go on claim, the policy won't lapse. And I think it's 24 months. If you've been on claim for 24 months, I may be off on that figure, but it's a period of time like that. If you're on claim for that period of time, they just go ahead and suspend the payments forever and just say your policy's paid up. It doesn't matter, if you came off claim at that point.
Alzheimer's seems a concern. Which is the best rider for that possibility?
I would say that a chronic illness or long-term care, any of the extra charge riders would be a great fit for that because Alzheimer's is going to trigger it, right, because it's going to be a severe cognitive impairment. So that will trigger those riders, and then they can get up to 2% of their death benefit per month. I think there's probably not going to be really any difference at that point between chronic illness and long-term care because you're not going to get better from Alzheimer's. So that's definitely going to be considered a permanent condition. So a chronic illness rider would work just fine for that.
Okay, and I don't think I see any other questions at the moment.
All right, great. Thank you, everyone, for taking the time to be on this call. I hope it's useful. Again, give me a call, extension 123. Andrew's call can also help you, Andrew Otten, at extension 143. Feel free to give us a call. Thanks, everybody. Have a good day.